Welcome back, listeners, to Am I Catching a Falling Knife? The show where we dive deep into stocks taking a tumble, trying to figure out if they're a bargain in the making or a trap to avoid. Today, we're sharpening our focus on a company that's seen some significant turbulence, the healthcare giant Centene Corporation, ticker symbol CNC. Let's dig in. All right, so CNC, or Centene Corporation, has certainly caught our eye, dropping significantly over the last few days. That kind of sharp decline always makes us wonder, are we looking at a genuine falling knife here? The core reason for this slide, the single most dominant market narrative, revolves around the ongoing concern over rising medical costs. This isn't just a vague worry. It's been exacerbated by Centene's recent disappointing Q2 2025 results, and, to top it off, a class action lawsuit alleging inflated guidance. Now, this whole situation is unfortunately overshadowing some genuinely strong revenue growth and what many see as positive long-term outlooks for the company. So, let's peel back the layers on Centene. They're a massive multinational healthcare enterprise, primarily focused on government-sponsored healthcare programs. Think Medicaid, Medicare Advantage, and even plans for those eligible for both. They're a big player, serving over 8.6 million Medicaid members. Looking at their revenue, 62% comes from Medicaid, 14% from Medicare, and about 21% from commercial plans. They reported a hefty $163.1 billion in their latest annual revenue, with a free cash flow of $1.492 billion. But here's the kicker. Their gross margin is relatively thin at just 10.27%. This makes them incredibly sensitive to any shifts in those medical costs we just talked about. So, how do these rising costs and that lawsuit really hit the bottom line? Let's break down the impact on earnings. Given that Centene's core business relies heavily on government healthcare programs, their profitability is directly exposed to medical cost trends. With their already thin 10.27% gross margin, even a small increase in costs can have a big effect. Our analysis suggests that these rising medical costs, coupled with those disappointing Q2 results, could lead to a contraction of their gross margin by about 3/4 of a percentage point, or 75 basis points. So that 10.27% could shrink to around 9.52%. Now, if we take their latest annual revenue of $163.1 billion, that averages out to roughly $40.75 billion per quarter. A 0.75 percentage point reduction on that quarterly revenue translates to a hit of about $305.8 million to their gross profit, and by extension, their pre-tax earnings. To put that in perspective, if we estimate their prior quarterly net income, assuming a typical 1.5% net income margin for a healthcare insurer, we're looking at about $611.5 million. So that $305.8 million operational earnings hit is roughly 50% of that estimated quarterly net income. And then you have the class action lawsuit. Beyond the legal fees and potential settlements, there's the reputational damage. We're estimating that could tack on another 3 to 5% reduction in earnings. So, when you combine the 50% hit from rising medical costs with the 5% from the lawsuit, we're looking at a total estimated reduction in quarterly earnings of around 55%. It's a wide range, yes, because quantifying these things precisely is tough, but that low gross margin really amplifies the risk. So, with that kind of hit, what is CNC actually worth? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow model. This model helps us estimate the value of an investment based on its future cash flows. For our base case, we're making a few assumptions. A growth rate of -8.6%, yes, negative, a discount rate of 9.5%, and a long-term terminal growth rate of 2.5%. With those inputs, our base DCF model suggests a value of about $36.17 per share. But then we have to apply the narrative's impact, that estimated 55% earnings hit we just talked about. When we factor that in, our narrative-adjusted DCF value drops significantly to just $9 per share. The second method is a bit simpler, a PEG-based valuation. Now, the PEG ratio, or price earnings to growth, is often used to determine a stock's value while accounting for its growth rate. Typically, a lower PEG ratio means a better value. However, in CNC's case, with that negative growth rate, the PEG-based fair value doesn't apply in the traditional sense, as it's designed for growth stocks. It's essentially null for our purposes here. So, if we combine the insights, especially from that narrative-adjusted DCF, it gives us some potential custom buy levels. Based on our analysis, if you're looking to consider CNC, you might be thinking about levels around $9, $7, and even $5, keeping that $9.04 narrative DCF value in mind. So, that wraps things up on Centene, CNC. Remember, this is our analysis based on publicly available data and should not be taken as financial advice. Every investment decision should be made after careful personal research and consideration of your own financial situation. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.